Thanks for joining us as I recap the market activity and events of the third quarter. I'm Frank Holsteen, Managing Director of Wespath's Investment Management Team, the team that oversees the management of Wespath's investment funds. I'll start with a story that may sound familiar if you've kept up with political news this year. Just like with the debt ceiling debate earlier this year, Congress waited until the last minute to reach a compromise to avoid a government shutdown by passing a stopgap spending measure. This means military personnel, national park rangers, economists who help calculate inflation, and many more federal employees will continue to be paid through at least mid-November. The debate that has been raging in Washington is about the federal government's growing annual deficit and national debt. Often, countries run a deficit to stimulate the economy. However, talk of a recession continues to be just talk, and unemployment levels are low. With this resilient economy as the backdrop, the U.S. federal net debt has climbed to 98% of GDP. This is the highest level of debt to U.S. economic output witnessed since World War II. And this is taking place while the U.S. Federal Reserve has been raising rates since March 2022 to fight inflation and cool the economy. At its September meeting, the Fed kept its policy rate at a range of 5.25% to 5.5%. Central bank officials signaled one more rate hike is likely in 2023 before an extended pause. The contradictory approaches taken by elected officials and the Fed will be important to monitor, as it will likely impact economic growth and inflation going forward. We should also note that the widely watched 10-year U.S. Treasury yield has risen from 3.96% on July 31st to 4.57% at the end of September. That's a very sharp move. It's the first time the yield's been above 4.5% since November 2007. That means it costs the U.S. government more to borrow money. It also impacts everyday people like you and me because it increases the cost of borrowing on items like mortgages and cars. Sticking with bonds, let's look at how the markets performed in the third quarter. The Bloomberg U.S. Aggregate Bond Index dipped 3.2% in Q3 as yields rose. Just a reminder, when yields rise, bond prices fall. The index is down 1.2% on the year. Stocks were also down in the third quarter. U.S. equities, as measured by the S&P 500 Stock Market Index, were off 3.3% in Q3. International equities were also down, with the MSCI EAFE index falling 4.1%. Both indexes had strong gains in the year's first 6 months and are still up 13.1% and 7.1% for the year, respectively. Many of the companies leading the market this year, such as Apple, Microsoft, and NVIDIA, are aligned with artificial intelligence and technology themes. These tech companies have demonstrated solid earnings growth, but that hasn't kept pace with their returns, as we can see in key valuation metrics like price to earnings. The price to earnings ratio equals the price of a share of stock divided by the company's earnings per share. This metric tells you how much you, as an investor, are paying for each dollar of earnings. The projected or forward price to earnings ratio for the 10 largest stocks is almost 26 times. That's more than 45% higher than the price to earnings ratio for the overall market. This trend probably explains why actively managed U.S. equity strategies have generally underperformed broad market indices over the past year. Many active managers don't want to overpay for expensive-looking stocks while also concentrating portfolio risk in essentially a single industry. We will continue to monitor what happens in Washington, D.C. and in the broader economy and update you on the most important developments. We're here to keep you informed while we remain committed to our long-term focus.